Ladies and gentlemen, what if I told you one decision by Russia could accelerate a shift that's been building for years in the precious metals market? While most investors are watching stock indexes and central bank headlines, something much bigger may be unfolding behind the scenes. Russia's latest moves involving gold and silver are raising serious questions about the future of global trade, currency confidence, and the real value of paper assets. In today's video, we'll break down what's happening, why it matters, and what it could mean for gold, silver, and investors worldwide. For years, many investors have focused almost exclusively on interest rates, stock market performance, or the latest inflation report. Those are certainly important, but beneath the surface, another trend has been steadily gaining momentum. Around the world, governments and central banks have been treating precious metals not as relics of the past, but as strategic financial assets. When a major nation makes a significant move involving gold and silver, it deserves careful attention, not because it guarantees immediate price spikes, but because it often reveals how decision makers are preparing for a changing economic landscape. Gold has always occupied a unique position in the financial system. Unlike paper currencies, it carries no counterparty risk. It cannot be printed into existence, and it has maintained purchasing power through wars, financial crises, currency resets, and countless political changes. Silver shares many of these monetary qualities while also playing a vital role in modern industry, making it a fascinating asset with both defensive and growth characteristics. When countries strengthen their exposure to precious metals, they are often sending a subtle but important message. They may be looking to diversify reserves, reduce dependence on foreign currencies, or simply build a stronger financial foundation against future uncertainty. These decisions are rarely made with next week's market in mind. They are part of long-term strategic planning that may unfold over years or even decades. This is one of the biggest misconceptions among everyday investors. Many people expect every headline involving gold to produce an instant rally. Real markets don't work that way. Large institutional decisions tend to influence long-term trends rather than creating overnight transformations. Patience has always been one of the greatest advantages for precious metals investors. Another point worth understanding is that governments typically don't make these decisions based on emotion. They rely on extensive economic analysis, geopolitical assessments, and risk management strategies. If precious metals continue to play a meaningful role in official reserve management, it's because they continue to offer qualities that no fiat currency can fully replace. Gold serves as financial insurance. Most people don't buy insurance hoping they'll need it tomorrow. They buy it because uncertainty exists. Nations think in much the same way. Economic shocks, banking stress, debt concerns, inflation, and currency volatility are all risks that can influence reserve management decisions. Holding physical gold provides one layer of protection against many of those unknowns. Silver deserves equal attention, although for different reasons. While gold is primarily viewed as a monetary asset, silver occupies a unique position between monetary demand and industrial demand. It is essential in electronics, renewable energy technologies, medical equipment, telecommunications, and countless manufacturing applications. At the same time, investors also purchase silver as a store of value during periods of economic uncertainty. This dual demand creates interesting dynamics. During periods of expanding industrial production, silver demand can increase significantly. During periods of financial stress, investment demand can also rise. Sometimes these two forces reinforce one another, creating strong upward pressure over longer market cycles. One factor that often goes unnoticed is supply. Precious metals cannot simply be manufactured whenever demand increases. Mining projects require years of exploration, permitting, financing, and construction before new production reaches the market. Even existing mines face declining ore grades, higher operating costs, and increasing environmental challenges. That means when demand rises steadily while supply grows slowly, markets naturally become tighter. This doesn't guarantee immediate shortages or explosive price movements, but it does establish conditions that can support stronger prices over time. It's also important to separate speculation from fundamentals. Daily price movements are often driven by futures markets, investor sentiment, currency fluctuations, and short-term news. Those factors create volatility that can distract investors from the bigger picture. Long-term fundamentals, however, tend to be driven by physical supply, physical demand, monetary policy, and central bank behavior. Experienced precious metals investors understand this distinction. They don't become overly excited during every rally, nor do they panic during every correction. Instead, they monitor the underlying trends that develop over many years rather than many days. Diversification is another important lesson. Precious metals should never be viewed as an all-or-nothing investment. They represent one component of a balanced financial strategy. Gold provides stability and wealth preservation, while silver offers additional upside potential due to its smaller market size and industrial importance. Together, they can complement other investments rather than replace them. History repeatedly reminds us that confidence in financial systems moves in cycles. Periods of optimism are often followed by periods of caution. During those transitions, investors frequently rediscover the value of tangible assets that exist outside traditional financial structures. None of this suggests that prices move in a straight line. Markets rarely reward impatience. Corrections are normal, volatility is expected. Even within powerful long-term bull markets, temporary setbacks can shake out weak hands before larger trends continue. The key takeaway isn't about predicting tomorrow's price. It's about recognizing that when major economies continue treating precious metals as strategic assets, individual investors should at least understand why. These decisions are made with long-term financial resilience in mind, not short-term speculation. Ultimately, successful precious metals investing has always been about discipline, education, and perspective. The investors who consistently perform well are usually those who avoid emotional reactions, focus on real economic fundamentals, and understand that gold and silver have served as stores of value for thousands of years. While markets will continue to fluctuate and headlines will come and go, the underlying role of precious metals in preserving purchasing power and providing financial diversification remains as relevant today as ever. For decades, the global financial system has revolved around confidence. Confidence in currencies, confidence in government debt, confidence in central banks, and confidence that the rules of international finance will remain relatively stable. But history teaches us that confidence is never permanent. It rises, it falls, and when enough nations begin adjusting their financial strategies, investors should pay attention, not because change happens overnight, but because the foundations of the monetary system often shift long before most people recognize what's happening. One of the biggest misconceptions in today's financial world is the belief that the US dollar's position is either completely secure or on the verge of immediate collapse. Reality usually exists somewhere in between. The dollar remains the world's dominant reserve currency, supported by deep financial markets, global trade, and decades of established trust. That position was not built in a few years, and it will not disappear overnight. However, that doesn't mean it is immune to gradual challenges. Markets are constantly evolving. Countries continuously evaluate how much exposure they want to have to any single currency or financial system. Diversification is something individual investors understand very well. If you wouldn't place your entire retirement portfolio into one asset, it shouldn't surprise anyone that nations also seek diversification within their reserves. This is where precious metals begin playing a larger role. Gold, in particular, has no nationality. It isn't issued by any government, doesn't depend on political elections, and carries no promise that someone else has to fulfill. It simply exists as a tangible financial asset whose value has been recognized for thousands of years. When governments increase their focus on physical gold, they are often reducing dependence on financial assets that rely on another nation's economic or political decisions. That doesn't necessarily indicate hostility toward the existing monetary system. More often, it reflects prudent risk management. Think about what has happened over the past several years. Inflation has reappeared after many believed it was permanently under control. Interest rates have moved sharply higher. Government debt has continued expanding across many major economies. Geopolitical tensions have increased. Supply chains have experienced disruptions. Banking systems have faced unexpected stresses. None of these developments automatically destroy confidence, but together they encourage policymakers to prepare for a wider range of future possibilities. Markets respond not only to facts, but also to expectations. If investors believe economic uncertainty will persist, they often begin shifting capital toward assets perceived as safer stores of value. That's one reason gold frequently performs well during periods of heightened uncertainty. It isn't always because conditions are already bad. Sometimes it's because investors expect risks to become more significant over time. The US dollar itself often experiences a similar dynamic. During global crises, capital has historically flowed into dollar-denominated assets because investors viewed them as relatively safe. That relationship, however, is not fixed forever. Financial systems evolve, and diversification gradually becomes more attractive as global economic power becomes increasingly distributed across multiple regions. This doesn't necessarily mean the dollar loses its dominant role anytime soon. Instead, it suggests the world may become more balanced with multiple reserve assets playing important roles. Gold can become one of those balancing assets because it operates independently of national monetary policy. Another factor many investors overlook is the relationship between debt and currency confidence. Governments around the world continue carrying historically high debt burdens. Managing those obligations becomes increasingly challenging when borrowing costs rise. Central banks often face difficult choices between controlling inflation, supporting economic growth, and maintaining financial stability. These competing objectives create uncertainty for investors. Every policy decision produces trade-offs. Raising interest rates may slow inflation, but can pressure economic growth. Lowering rates may stimulate activity, but risk reigniting inflation. Expanding liquidity may stabilize financial markets while potentially weakening purchasing power over time. This balancing act is one reason tangible assets continue attracting attention. Precious metals cannot solve economic problems, but they can serve as financial insurance against policy uncertainty. Silver introduces another interesting dimension into this discussion. Unlike gold, silver derives value from both monetary demand and industrial consumption. As global investment in technology, renewable energy, electronics, and advanced manufacturing continues expanding, industrial demand for silver remains an important long-term driver. If investment demand rises simultaneously with industrial demand, silver markets can become significantly tighter than many investors anticipate. Because the silver market is considerably smaller than the gold market, relatively modest increases in investment flows can sometimes produce disproportionately larger price movements over extended periods. Again, this doesn't guarantee immediate rallies. Markets rarely move in straight lines. Corrections remain normal. Volatility is part of investing, but understanding the underlying supply and demand fundamentals provides much better perspective than reacting emotionally to daily price fluctuations. Another important consideration is market psychology. Investors often chase performance after prices have already risen substantially, then become discouraged during temporary corrections. Experienced precious metals investors generally approach markets differently. They recognize that periods of weakness often occur within larger long-term trends. The goal isn't predicting every short-term move. Very few people consistently accomplish that. Instead, the objective is identifying structural changes that unfold over many years rather than many weeks. Financial history repeatedly demonstrates that monetary systems evolve gradually before reaching noticeable turning points. Few transitions are obvious while they are happening. Looking backward, however, the evidence often appears remarkably clear. That's why disciplined investors spend less time reacting to sensational headlines and more time examining long-term trends. They monitor reserve management, debt growth, inflation, monetary policy, mining supply, industrial demand, and investor sentiment collectively rather than focusing on any single event. Ultimately, the future of global markets will not be determined by one country, one policy decision, or one headline. It will be shaped by countless decisions made across governments, central banks, businesses, and investors over many years. Throughout those changes, gold and silver continue serving the same fundamental purpose they have fulfilled for generations, providing diversification, preserving purchasing power over long periods, and offering an alternative financial asset that exists outside the promises of any individual government or monetary authority. That enduring role is precisely why precious metals continue attracting attention whenever uncertainty becomes part of the global economic conversation. If there's one lesson that precious metals have taught investors over the decades, it's that patience is often rewarded more than prediction. Too many people enter the gold and silver market expecting instant gains after a major headline or geopolitical event. When prices don't immediately explode higher, disappointment sets in, and they begin questioning whether they made the right decision. But successful investing in precious metals has never been about chasing the next big move. It's about understanding the bigger picture and allowing time for long-term trends to develop. The first thing every investor should recognize is that gold and silver serve different purposes within a portfolio. Gold has traditionally been viewed as financial insurance. Its primary role is wealth preservation. It may not always be the fastest moving asset during strong economic expansions, but its strength becomes more apparent during periods of uncertainty, inflation, financial instability, or declining confidence in paper assets. Silver, on the other hand, has a different personality. It's both a monetary metal and an industrial metal. That combination makes it far more volatile than gold. During bull markets, silver often outperforms gold on a percentage basis. During corrections, however, it can also decline more sharply. Understanding this difference helps investors avoid emotional reactions when volatility increases. One mistake that new investors frequently make is treating volatility as risk. Volatility simply means prices move around. Risk is something entirely different. Real risk comes from purchasing assets without understanding why you own them. If your investment decisions are based solely on headlines or social media excitement, every market correction feels like a disaster. But if you understand the long-term fundamentals, temporary price swings become much easier to manage. Another important factor is maintaining realistic expectations. Precious metals are not magic investments. They don't eliminate risk, and they don't guarantee profits. Like every asset class, they experience cycles. There are periods when they outperform other investments and periods when they lag behind. That's perfectly normal. The key is understanding why you own them in the first place. If your objective is preserving purchasing power over many years rather than maximizing short-term returns, then daily price fluctuations become much less important. Diversification remains one of the most valuable principles in investing. No single asset should carry the responsibility of achieving every financial goal. Stocks provide growth opportunities, bonds can generate income, real estate offers another form of tangible wealth. Precious metals add diversification by providing assets that often behave differently during economic uncertainty. This balanced approach reduces dependence on any one market or economic outcome. That's precisely why many experienced investors include precious metals as part of a broader financial strategy rather than treating them as speculative trades. Physical ownership is another consideration that deserves attention. While exchange-traded funds, mining shares, and futures contracts all have their place, physical gold and silver remain unique because they carry no counterparty risk. They don't rely on another institution fulfilling a contractual obligation. For many investors, that characteristic is one of the primary reasons for owning precious metals in the first place. Mining companies, meanwhile, offer different opportunities. When precious metal prices rise significantly, well-managed mining companies can experience stronger earnings growth than the metals themselves. However, they also introduce business risks such as operational challenges, political uncertainty, production costs, and management decisions. Understanding these differences helps investors choose investments that match their own objectives and risk tolerance. Supply fundamentals also deserve careful attention. Bringing a new mine into production is neither quick nor inexpensive. Exploration, permitting, financing, environmental approvals, and construction often require many years before meaningful production begins. At the same time, existing mines frequently encounter declining ore grades and increasing production costs. If demand continues growing while new supply remains relatively constrained, long-term market conditions can gradually become more supportive for prices. Again, this doesn't guarantee immediate appreciation, but it establishes favorable fundamentals that may influence future market performance. Industrial demand adds another layer of support, particularly for silver. As technology continues advancing, silver remains essential in electronics, renewable energy systems, medical applications, communications equipment, and numerous manufacturing processes. Unlike many industrial commodities, silver also retains its monetary appeal, allowing two independent demand sources to influence the market simultaneously. Investor psychology often creates the greatest challenge. Human nature encourages buying after prices have already risen substantially and selling after corrections have already occurred. This behavior repeatedly